Hey guys, welcome back to the channel. My name is Millionaire. If you're new here, you might not know, but we talk about everything personal finance, personal development, budgeting, investing, being savvy with your money. So yeah, if that's a topic that interests you, don't forget to do the necessary, hit the notification button, subscribe, comment, share with people who are trying to be also financially savvy. So today's topic, we'll just be talking about something that every smart investor should know, and it's just diversification is something that is very important for you as a smart investor because it allows you to protect your portfolio. It allows you to take advantage of markets full circle, and it also balances out risk, so you are more protected than someone who has not diversified their portfolio. So basically, diversification is all about not putting all your eggs in one basket, because let's say you invest in one asset class and it fails and all your portfolio is wiped out. That is crazy, because you need to invest in something, in things that protect your portfolio. They give you capital preservation, they allow you to sleep well at night, and they are also generating income. So let's diversify into how you can diversify your portfolio. And this is a journey of consistency, it's a journey of building slowly, but you can't be consistently investing in the wrong thing. You need to diversify in order to just be safe. Okay, so like we've talked, diversification is about spreading all your money in different asset classes like bonds, stocks, land, rates, crypto. And this protects your portfolio, because let's say one asset class performs badly, it doesn't mean that your portfolio is wiped out. Also, when one thing performs badly, it's balanced out by these other assets that are performing well. And it also allows you to benefit from different markets. You benefit from bonds, you benefit from stocks, you benefit from rates, you benefit from so many, like you benefit from everything. You're not just taking advantage of one thing. So let's dive into how you can diversify your portfolio. The first thing is to have your emergency fund in a high yield savings account or a money market fund. So before you even think of investing big or whatever, you need a safety net, because we've talked about this before. Emergency funds protect your portfolio, they protect your long-term assets, because you don't have to liquidate your assets in order to handle an emergency. The good thing with HISA and MMFs is that they have small interest. So the good thing about it is that it helps you beat inflation. Your money is not reducing in value, and also it helps you not liquidate your long-term assets. And also storing it in a high yield savings account or a money market fund makes it more accessible, so you're not stuck when you want to handle an emergency. You can withdraw money from a money market fund in 2 to 3 days, or a HISA, you can remove it within like a few days. The other thing that you need to invest in is obviously treasury bills and treasury bonds. These are my personal favorite. They are fixed income securities that pay fixed income at fixed periods of the year. So for treasury bonds, they pay interest twice a year. So if you invest in a bond, you'll be getting income every 6 months. If you invest in a treasury bills are sold at a discount. So let's say there's a bill going for 80,000, you will buy it at 80k, but the government will pay you 100k at the end of the 91 days or 182 or 365, because bills are short term. So yeah, these are ways that you can make money. And the other hack that you need to implement when you're investing in bills and bonds is bond layering. This is like dividing your bonds to different months so that you receive an income every month. So let's say we've said that a bond pays you income twice a year. So you can invest in 6 bonds, you spread them out over 6 months in a way that you'll be getting income 12 times. That is over the whole year. You have an income, and this is one way that is helping people retire early, because you have invested. So every month you get an income, you don't have to work, and you don't have to stay in a bad job that you don't like, because you have passive income, which is, guys, please, this is the thing that we need to be focusing on. So the good thing with bonds is that they're steady, they're predictable, they're reliable, and they ensure capital preservation. Let's say you bought a bond for 5 years. At the end of the 5 years, you will receive your initial investment, and you have been receiving the payments per year. So guys, it's a good option that can help you retire early. The other option is dividend paying stocks, and these are also a personal favorite. Dividend paying stocks are generally just you as an investor, you buy a part of a company, and because you have invested your money in the company, when the company makes profits, it shares the profits to you in terms of dividends. Dividend stocks are obviously better than capital stocks for me, because I'm a passive investor. I'm not an active trader, so I'm not able to time the markets when the capital gain stocks is gaining so that I sell. I'm not able to do that, so I prefer dividend paying stocks, because I'm also looking into a long-term journey. I'm looking at a long-term itinerary. I'm not trying to get rich quick. I would love to get rich quick, but it's not like the easiest way to find. So my personal favorites in Kenya include Standard Chartered, Stanbic Bank, Cooperative Bank, Absa Bank, NCBA, and they are doing really well. So guys, please consider investing in dividend paying stocks, and you will not regret it. They also ensure that your capital is being preserved. Unlike capital gain stocks, sometimes if the stock goes to zero, you can lose all your money. Okay guys, and the good thing about dividend investing is you can buy 100 shares. You don't have to buy the whole company. They allow for fractional investing, in a way that you invest some part of your money, you buy a few shares, and you keep adding over time. When you reinvest the dividends, you can snowball your portfolio in a way that you will not believe. The other way that you can definitely diversify your portfolio, one of the best ways that smart investors are doing, is through ETFs. These are exchange traded funds. In layman's language, an ETF is a basket of stocks that trades as a single stock. So if you don't want to buy a single stock of Apple, Amazon, Meta, Safaricom, you buy an ETF. An ETF is a basket that contains all these stocks. Like, let's say the S&P 500 in the US has like 500 top companies in the US. So the ETF called VO tracks this S&P 500. It copies the performance of the S&P 500. So I hope I've not complicated it, but it allows you exposure to global markets without risking on one stock, one asset. So ETFs like SPY, VO, IVV, and VTI are popular and trusted, and they're perfect for beginners and for seasoned investors, because they offer diversification at a low risk, and that is what we all want. So guys, keep on the lookout. I'll be making a video on how to start a journey on investing in ETFs, how to open a brokerage account. It's not hard, guys. The other way that you can diversify your portfolio is through REITs. These are real estate investment trusts, and REITs are companies that own malls, they own estates, they own hotels, they own hospitals. And so when you invest in a REIT, when a REIT collects the income, the rental income, they share the dividends with the investors. You don't have to buy a whole mall, because that's crazy as of now. But you can be an investor in the mall, and you will be getting dividends. So guys, this is a smart way of investing. in real estate without going through the crazy way of buying land or having a mortgage. And you know, the good things about rates is that they are obliged to pay at least 90% of their income. They are obliged to pay it to their investors. So this is a great way to tap into the real estate market without the hassle of being a landlord, and it saves you different costs of repairs in the house, tenants, drama. It's just a good way to invest. And in Kenya, some of the rates are Ilam Fahari rate, which is listed in the NSE National Stock Exchange. Yeah, and also it owns Kwetu hostels, the ones that are near USIU. So guys, rates are a good option, and they also allow for fractional investing. You don't have to have a whole lot of amount of money to invest. You can start your journey with less. So let's talk about the other common thing, which is land. And I know many people see land as the ultimate investment, and I know it's a good long-term asset, but you also have to think strategically. Remember, we are trying to have assets that are enhancing our life, not just assets on paper or just to brag that you have assets and they're not even generating any income. Your goal should be to stack capital generating assets, and you should also, if you want to invest in land, you can add value to it, or you can practice agribusiness, which is a good way, because when you add value to the land or you conduct a business there, it's generating income. But most of the people make a mistake of thinking they'll just buy land in random places and that the land will appreciate, and sometimes it doesn't appreciate, or sometimes if you don't do your due diligence properly, the land might get reclaimed by the government, or it might be illegal, it might be a riparian land. So guys, please do your due diligence, think strategically. You can first focus on generating assets like bonds, bills, ETFs before you buy land. But to each their own, guys. This is not financial advice, it's just my thoughts. And yeah, you can diversify your portfolio. You don't have to make a whole portfolio. You have like just land in your portfolio. You need to diversify. Remember, that's the whole point of this video. And also the other thing about land, when you want to liquidate it for an emergency, you cannot, because it takes time to sell land. And sometimes also when you're liquidating the land, you incur fees, lawyer fees, transfer fees. So guys, consider other income generating assets before buying land and being like, oh my god, I have to own land. But it's a really good achievement. I wouldn't mind having several title deeds in my bank, but yeah, you need to prioritize. And also the other thing I didn't say is that you don't have to start with everything. You don't have to start with bills, bonds, money market funds, land. You can start with your emergency fund. When you're done with that, you move on to a treasury bond. You buy one, you save for another, you buy two. The next thing, you move into rates. The next thing, you start investing in ETFs. The next thing, you start buying land. Like, you don't have to do everything at once. Okay, so to put it all together, let's see how you can build a portfolio that will build wealth while managing risk. You can stack your emergency fund in a HISA or MMF. Treasury bills and bonds are good for passive income and retirement. Dividend paying stocks are good for passive income. ETFs are good for broad market exposure, and they also pay dividends, I think, yearly. Rates are good for real estate income without the hassle of being a landlord. And land is good when it's strategic and you're sure that it will appreciate and you sell at a profit. And it's also good if you're adding value and you are performing agribusiness. So guys, diversification and wealth building doesn't have to be fancy, but it's boring. You have to accept that wealth building is a boring journey, and this allows you to sit back and just breathe and build your portfolio slowly. So guys, I'd like to hear how you're building your portfolio, how you're diversifying your portfolio, what you are prioritizing in your portfolio. I'd like to hear all that. Please subscribe, comment, share with someone who's trying to build their journey, their wealth journey in a smart way. And remember, wealth building is not a race. It's a journey. It's a marathon, not a sprint. Like, we go slowly, we achieve this, we set it aside, we attack another goal, we achieve, and that's how we are going to keep being good. So guys, I hope you enjoy the video, and I will see you next time. Bye.